Welcome to Behind Closed Books, the podcast where business owners and experts reveal the financial decisions that shape their success. Each episode brings you unscripted stories of turning points, hard calls, and the numbers that changed everything to pivot, recover, and grow. If you're building a business and ready to think differently about profit, pressure, and progress, behind every smart decision is a story worth telling. This is the show. Here is your host, Craig Sheets.
Hello, everybody. Welcome to another episode of Behind Closed Books. My next guest today is an avid bass fisher and even went to the national finals for his university team at UCF. He has funded an extremely large 84 single-family residence property, financed the golf course from application to close in 72 hours. He's the chief production officer of a private lending company. With that, everybody meet my next guest, Dustin Lauer. Welcome to Behind Closed Books, Dustin.
Thanks, Greg. Good to be here.
I'm really excited to have you here today. There's a lot of things we can talk about in this market right now. Some of the topics I thought we could touch on today is why people should finance utilizing private money lending versus going to a bank, and what are some of the key benefits going into what is hard money lending. Also, what will people need to qualify for private money lending, like loans? What's unique about some of the accounting aspects maybe of that business? We can kind of go into that a little bit more. What are some areas in today's mature market, I guess we can call it, with the way financing is working, with the types of transactions and locations that work best for investors in a mature market, duplex homes, LLCs, not putting things in S corps. With that, why don't we get started on maybe why people are financing utilizing private money versus going to a bank? What are some of the key benefits?
Sure. Thanks, Craig. I'm glad you went through those again for me. So why do people kind of come to us versus, or competitors in our niche versus like using a bank for financing an investment property purchase or refinance? I think the key reasonings and differences, like the rates are pretty similar. I think that's a uncommonly understood that the rates are so much higher with private capital. So private capital has become very institutional, actually, since 2015. A lot of large hedge funds, life insurance companies, private equity have supported our space. Today, it's probably to the tune of, on the short-term loans, maybe $60 billion per annum of capital. There's a lot more capital when you include the ground up construction and all of the rental properties, but so that's really compressing rates a lot. But I think the reason people generally use a private lender versus the bank is speed, certainty of execution. You want to make sure you're putting hard money, your money into escrow that you're risking, and you want to make sure you can close not only in a timely manner, but also at the terms that you were expecting. And then after closing, a large reason is the handling of the construction funds. So people don't want to go through the rigmarole of taking 3-4 weeks to get a construction draw from a bank versus, having, more of a business understanding of what they're doing, having a team that can deploy the construction capital, check your permits, make sure everything was good, get lien waivers, and get funds out in a day or two after inspection. That's a big reason. I think also, besides certainty of capital and execution timing and, the draw process, it's kind of like you work with a specialist accountant if you have a specialist business. And so you work with specialty finance when you have a unique, transaction. So if you're fixing and flipping, if you're, buying rental properties, if you're building rental properties or building properties for sale, working with a lender that fully understands your business needs and scenarios versus a bank that's a very small piece of what they finance.
Right. And with private money lending, do you have to be the actual the organization itself? Does it have to be organized as a bank, or is it just a group of people that do that funding through the private money lending side?
There has been a couple that have gone the route of registering as a bank or being acquired by banks. But banks have a lot more restrictions on where they lend, and there's a lot more oversight into banking. Some for good reason, from what happened in 2008. Some, it's a little bit restrictive. So that hasn't worked out well for most. But one of our large competitors is the bank, and it works well for them nationwide. So it can be done, absolutely.
I saw that movie. Was it Too Large to Fail or something like that? What was that called? Too
Too big to fail? Yeah.
Too Big to Fail. I was like, yeah, this is just what was happening behind the scenes. They were just pushing money through the opposite of what it is now. I feel like the underwriting requirements have almost gone too far and through the roof. Like I have a lot of clients that have, I don't know, they're making maybe, $1 million a year in earnings and or maybe the opposite. I take that back. Maybe they have $1 million or $2 million in assets, but they're making an average earning. But they're putting through this criteria saying that, well, you have too much assets but not enough income, or if they have a lot of income but no assets, so well, you don't have any assets to support your income, and what if something happened? It seems to be they've gone too
So
far.
I will say, yeah, I will say we missed a big point on your first question. It is not an income based underwrite. And like a bank is usually underwriting based on a ratio of debt outstanding to to the sponsor or the borrower guaranteeing a loan, and then the ratio of how much debt they have to how much income they have. And that DTI, debt to income ratio, is usually a large piece of a bank underwrite. Whereas in our space, if there's an income component, it's the cash flow from the investment property. We still check credit, background. I think in general, we do a more thorough underwrite than what a conventional loan requires.
Interesting.
And in a lot of cases, we're underwriting on an as is value and a finished value if there's a renovation or construction component to the loan. So it can be more of a mortgage file in a lot of ways, but we do skip the piece around income verification, and that is a large reason why, for investment properties only, why people seek out private capital.
That makes perfect sense. So would anybody want to buy a home to renovate it before they move into it and should we use the word hard money lending? Is that a good terminology for it? Would they want to use private money to use, let's say, a 6 month or 1 year renovation on a private residence before they moved in, or would that not be productive?
For everyone in our space, we don't allow any intention for owner occupancy, and that's not so much like our space has set this requirement. It's more of legislation has really disallowed shorter term loans and renovation loans for owner occupants. So, yeah, it's a little bit prohibitive in the legal environment for private lenders to finance for the intention to be owner occupied. But you know, we do the loans for somebody to buy, renovate, and rent or resell the property.
Right, that makes sense. So you're really doing this for the people who are trying to invest into maybe a duplex property to have that hold it for investments in the future, or for a large apartment complex or some type of property that they're going to rent out and utilize in the capacity from well, rental. Is rental income the only type of properties that you guys would invest into for private money lending, or is there other types of businesses related to real estate that you might fund for those kind of things?
Yeah, it's a healthy portion. So today's market, a lot of people are buying lots or buying homes to tear down, building a new home, and then putting a tenant in there, renting the property out, and then refinancing with us one more time into a long-term product. And we size the initial loan so that it can be exited via refinance. We do that underwrite ahead of time for them.
Okay, and what's the usual term? Like, what's the minimum term, and what's the longest term you can do through? And I don't know if I want me to call it hard money lending or private money lending. Sounds maybe better.
Yeah, I think there's a push in our space to call it private lending, but it's become so institutional, and it's become so not expensive that hard money is usually not the best term today. But um, it is either way. We kind of hold ourselves out there as a private lender, but we have a lot of institutional backing, and it's kind of the market's changed a lot, but that is what people understand it to be. So we consider both.
And what's the term? What's the terms? Like, is short like period and a long period that you can do?
The shortest term loan we do is for a year. So it's 12-month term. And then, we do a lot of like heavier renovation projects or larger constructions. Those will usually go 18 to 24 months. And then long term, we have a fully amortized 30-year mortgage.
Oh wow.
So
Oh my goodness gracious. Is there certain rates I mean, obviously the point differential is going to be different from private money lending versus a bank, but is the differential significant?
I'm glad we're recording this today. So, our floor rate today is 5.5
Wow.
on our DSCR rental loan product. And what that stands for your listeners is debt service coverage ratio. So it's how much money the property makes over the payment. So if it rents for $2,000 and the payment is $1,000, it has a 2 debt service coverage ratio.
Okay. Okay. Whereas opposed if I'm getting a mortgage through a bank, they look would you say DTI? Was that the terminology for private?
Right. Exactly. Yep.
This is just DT. What was it?
Yeah, it's funny. There's some people out there calling it PDTI, the property's debt to income. It's just the debt service. It's just the how much rent is more than the payment.
That makes sense because what you don't want to do is get yourself underwater and all of a sudden after a year go, hey, this is a great idea getting into the rental space. I've never done it before, but I just realized my payment to the bank and my rent I'm receiving is the same, but now the toilet broke and the refrigerator broke and the roof needs to be replaced, and all of a
There's
sudden
always something.
it's always something, and you need to have that little bit of extra money in there. So it's good you do that to maybe even help some of the newer investors that think, I didn't even think about having that extra money just in case something happens down the road. So we
Yeah, and like for the larger loans, like where we have more than 5 units, in those situations, we do actually reserve for, CapEx expenditures and, some maintenance items, vacancies, those sort of things, property management. But on the single family 1 to 4 unit stuff, we don't. We just make sure there's a little bit more rent than the payment.
okay. And I heard something, and I'll just bring this up before we talk about something else, but I heard something about I'm gonna try probably get it wrong, right? Maybe Fannie Mae or Freddie Mac had said if you have a duplex and you wanted to live in one of the sides of the duplex for a year, and then after that you can rent it out, you can do a 5% down payment for those kind of loans. I know that's not your world. I know it's not private money lending, but have you heard something along those lines where there's a smaller deposit if you live in a duplex for a year? Or maybe I'm wrong about that. Maybe you don't know. I don't know.
So in 1 to 4 units, like what's available from Fannie Freddie, it's come way down in the down payment range. Something close to that is what's available today. There's also really cool products like Home Style and 203K from FHA, where you can actually renovate the property as well, and then move into one of the units. If it's single family, you can do it there as well. So there's really good conventional products, but typically it's eventually going to limit to what the person's debt to income is, and usually somewhere around 10 loans is going to be the cap. So if you're doing this for a portion of your retirement or solely for retirement purposes, eventually you might surpass your ability to get more conventional loans based on your income, even the property's income counting for a portion of that. And look out for other lender financing options. What's interesting is we've actually been underpricing a lot of conventional loans in our space for the last 2 years. Um, so rates went up a lot, maybe 2, 3 years ago now. But even so, conventional rates for a non-owner occupied property, so a conventional rate on an investment property, we've usually been inside of that, really for at least 2 years, for what like the rate that our industry would offer. The trade-off is usually that there's a prepayment penalty on the loans. So that's usually like 3% the first year, declining 2% the second year, 1% the third, and it goes away thereafter. That's a very common version. There's about 5 or 6 different options out there usually, but
'Cause I think I've known you for a while now, and I felt when we first were talking about this industry, when you've been in it for a while, going way back, I always thought that private money lending was like double to triple the rate, and maybe that's just old legacy knowledge and things have changed, or maybe I misunderstood. But I always thought private money lending was usually about time and a half or double of the bank's rate. Sounds like that's changed, or maybe I misunderstood it.
So on the long, it's just become very institutional. So like on the long term loans, it's gotten a lot lower. There's been a lot of rate compression, and there's been a lot of like leaders in our space that were like the first companies to go out and issue enough loans that they could go ahead and securitize, go to bond markets, eventually get ratings on those bonds. Now those ratings are very good. They have a lot of execution. Investors, banks are buying these. Life insurance companies are supporting as well, and they're able to get a pretty good yield on their money at a lower risk because it's not only the person's financials covering the loan as a guarantor, but also the rental income of that property. And those have been performing well, I think, in capital markets to bring rates down. But on the short term side, we lend out at like higher single digits across our space. So, like, we'll have loans at like 8.9, 9.25. That's on the short term loan side, but that's only on the funds that the client has received. So, let's say there's a $50,000 advance on a $90,000 lot, and then you're building the house for 200,000. So you have a $50,000 advance and a $200,000 escrow for the construction, and then you're only paying interest on the first 50,000 that you received. So if you annualize the rate over all the draws, it's going to be much lower than maybe even a normal mortgage.
Wow, that's really changed a lot. And I know before we talked about it real quick about what the debt to equity or income ratio was, but maybe just go through again, like what do you need to qualify more in a specific level for private money lending loans? I guess I know we kind of touched very high level on that, but is there something more you can expand on that, or do we kind of cover it enough?
Oh yeah, they can definitely expand. I think it's super important for folks that are interested to get a loan in our space to really kind of have certain ducks in a row, so to speak. You know, so like in order to qualify, it does help to have experience. If you don't have any experience yet, like you're still going to be able to get financing in our space. It just may be at a lower advance rate than more qualified individuals that have more experience. They have a proven track record that shows the lenders that they're going to be able to, get through their transactions. So that's really on the renovation construction components. On loans that have just for rental income, it's about the same for everyone across the board. If you have a ton of experience versus it's your first time, it's really going to be based on the cash flow of the property and your credit score. So things I would recommend to be get ready to get pre-approved for anybody across our industry. It's not required for most of the lenders in our space to have a business entity, but it is a good idea because some lenders require it, and it's also helpful for your side of the business world, Craig, to keep it into an entity and run your accounting separate for that. Um, a lot of lenders require it, so that's helpful. And you want to have a governing document for that entity. So, not only are you going to have a formation document for creating it and then get your IRS EIN letter, but you're also going to get, put together a governing document, with a lawyer or some, company online. That's a lawyer online.
That's interesting you touched on that because from a point of view as an accountant, I'd change my ways a bit. I first, going way back, with rental properties, I was really, really heavy on having my clients work on investing their rental properties with an S corporation. But after a while, what I said was, well, what happens is when there's any transfer of ownership or any inheritance or estate tax issues, things get a little bit more complicated and tax heavy and more difficult to transfer that from one member shareholder really is the name for it now to someone outside the S corporation. So what I've kind of pushed people to do is if you know who's going to be in the legacy of your inheritance, in other words, if you know who your dependents are going to be, who's going to be your beneficiaries, I should say the word beneficiaries of your estate, then what you could do is start more of a partnership and you could do the ownership based on, let's say, 50-50, or if there's four of you, 25%, if it's three, make it equal per stirpes. It's a rule word they use, silly word, but You want to use it for stirpies. And then what you do is you pass along that lineage, you pass along that property easier. But I have found now with individuals that don't really have an idea, or if they're younger, about their estate plan and beneficiaries, I've actually had people stop doing S corporations and owning the property in the name of a limited liability company only, an LLC. And the reason I've done that,
Just as a pass through.
just as a pass-through, the reason I've done that is because I want my clients, and you probably want your I guess you call them your clients as well, your customers. You want to call that, you want to make sure you're protected.
I don't like to call them borrowers. I think that our space, is very like credit centric. It's very like, credit focused, and we refer to the customer base as the borrowers. I always think of them as our clients, and I coach all of our sales staff. When you're on the phone with them and you're sending emails, like you call them your clients, not your borrowers. It's not some relationship that's, subservient or anything like that. It's really like you're successful when they're successful, and like any other business, they're your clients.
It's funny you say it, because whenever I think of private money lending, I think of like one of those fancy, wall buildings that have really nice, wood paneling, and the money's in there. You have more like relationships, as you just said, with people, rather than just a number. If you go into like a Chase Bank, or I was going to say Key Bank, that's up in Buffalo, but whether you go to like Bank of America, you're just like, okay, next, you're taking a ticket like you're going to Publix to get or Wegmans if you're up in Rochester. But anyways, you get
Oh, there you go.
yeah, you get a ticket at a deli
Best
counter.
grocery store.
Yeah, that's the best grocery store. There's no feeling of connection. I feel like with private money lending, you have a tighter connection with your base. So when I want my clients, or your customer, your clients, to have protection, I feel it's really important for them to set up an LLC, because from a legal standpoint, if something happens in that property and there's not an LLC, the first person they're going after is people with the deepest pockets. And if that's you as the owner, they're going right after you. Without that LLC boxing you in and protecting you, there's no area in which they can't come after you because they hurt themselves, or something fell from the house, or a cabinet fell over. I'm just thinking of silly examples, but you need that protection there from a legal standpoint. As far as from an accounting standpoint, it's still going to be similar. You're still going to put it on your personal tax return. It's still going to be on your Schedule E. You're going to take your depreciation, your mileage if you drive back and forth to the property, and all your maintenance and insurance. That's not going to change. But from a protection standpoint, and I'm sure your side's concerned as well, the LLC is very important, I think. And you mentioned something about
A lot of the lenders in our space require it. I think some of that stems from a lot of the laws in our space where like we're making a business loan for business purposes, right? And so it's a lot easier for us to justify the loan that is within that regulation is if we're making a loan from a business to a business. But in a lot of scenarios and states, like our industry will finance into individual names. But it just helps opens up all the opportunity, a lot of more financing options for the client if they're able to, register an entity, whether that's a corporation, whether that's an LLC, depending on the tax classification of the LLC. But I'll mention something else about getting approved. A lot of our industry will finance clients where they can match up with other partners, legitimate business partners, for like, let's say you have a friend that has built a few homes, or you have a friend that has a family member that has, flipped a few properties or bought on properties and refinanced them and exited, short term, either all cash or another lender. Their experience is really good, but maybe they use their credit cards really heavily and they have like a 680 FICO. They're not as good credit score wise because they're running so much on the Home Depot card, or they have a account at a builder supply house or something, and it's really impacted their credit score. If you have great credit and together you both have some money and you guys want to do a project together, then lenders in our space will take their experience and your credit and cash together, and it can be a combination of funds. As long as all that capital goes into the business account and we can verify that it's there, then we'll finance based off someone's experience and someone's credit. And that can be really helpful, especially for investors that are getting started and want to get maybe a little bit better leverage, or, have somebody with more experience, really more importantly, in their transaction to help make it successful. So I think one of the things to consider early on is a partner.
That's really interesting you mentioned that, because a lot of people sit there on the sidelines going, well, I can't get involved. I don't know what I'm doing. I'm not sure what this is all about. I could lose out. But if you partner with somebody, if you have the funds and they have the experience, or vice versa, if you have the experience and you don't have the funds, either way, it seems like sometimes doing a partnership. And literally in that situation, I would then recommend to my clients that I've kind of gone away from in all disclosure, S corporations owning real estate. If there's two or more people, you can't really just do a single member LLC and do a Schedule E. You have to have some type of entity, whether it's an S corp, a C corp, or a partnership. I've usually kind of gone towards partnership as a structure to own business. But you're right. If you're sitting on the sideline and you don't have one or the other, partner up with somebody. Talk to somebody who has that experience, and if you want to work on it together, and that's great to know. You can be underwritten together, and I didn't even think of that. That's a great idea. That's amazing. That's great. And from a tax standpoint, there's so many tax advantages to doing rental properties, and if you can take that time to work with an accountant or a tax accountant to meet with them, it can help you out a lot. And a lot of times, I imagine maybe you have people that come to you, private money lending, that are starting off saying, "Geez, I don't know from a tax perspective." And I assume you don't have people on staff there that do tax advice at your company, do you? Do they have anybody who has tax advice that gives out advice for tax purposes where you are, or do you guys usually defer that to a CPA? Do you have CPAs on staff where you are, or do you refer your clients that have tax questions to a CPA?
So we don't generally get a lot of questions, but we always recommend that they get professional tax advice, um, from a real CPA, and then also we always recommend that anything on the legal side that they take it seriously. I mean, it's really hard to find a deal. I know one of your earlier questions and topics for us is that we're in a mature market, and that was a good way to phrase it from you. But in a mature market, it's hard to find a deal. So let's make sure we take everything as serious as possible on the tax and the legal side, to ensure that everything's going to go smoothly for you when you go to finance a transaction and it works out the way you want across the board. So I think it's important to take those things seriously. It can be one of those things you set up correctly the first time and get it right and do it professionally, versus maybe trying to cut some corners with, some online, versions, and maybe doing some things yourself.
Yep, I've seen people trying to use the legal Zoom, where they trying to use like a smaller or some kind of online tax thing, and just like maybe use some research. But when you use a professional, like you said, it may cost some money, but I think it's worth it in the end. That way, it's done right.
Especially if you're partnering up with somebody. I mean, heaven forbid you would ever litigate over anything down the road. You would really want to make sure that your governing document is done well so that covers those scenarios. Um, a boilerplate document, may not, cover all of the capital contributions from each party throughout the projects that you're doing together. So
That's a good point. And you mentioned it before about the mature market, and maybe I'm asking again, but I think it's a different question. But what types of locations work best for investors in mature market, or types of transactions, like whether it's duplexes or maybe certain areas, or what can you say about some areas in today's market for types of transactions and locations that work better for investors in this day and age?
yeah, a couple just very high level items is like it's not imperative that you invest in the market where you live. You can buy properties outside of the market you live in, a market that's performing well. If you live in Baltimore, Maryland, and it's not looking so good where you're at, or you're in Northport, Florida, and there's negative 10.7%, appreciation, which is depreciation. They don't like to call it that. You might want to invest into an area that is appreciating. So very quick free tools you can use online. Zillow has a home price appreciation index. Uh, they have a website. You can just type in the zip code and you can see if that area is going up in value or down in value. And it's easier to fix and renovate or build a property in an area that's going up in value, because if you spend more than you thought you were going to on the renovation or the construction, which happens, right? Uh, they say the sure things in life are death and taxes. I think the other ones, Craig, is that construction prices always go up. There's always inflation on everything, so things are always costing more than you think. So investing into an area that's going up in value is important. Uh, and I think, you know, I think net migration is another one. So if you look at where moving companies like U-Haul, where people are moving themselves, there might not be, Bridgeport, Connecticut, but people are moving themselves into, a lot of markets, and you can see where net migration exists and where job growth exists. You know, ChatGPT can give you some pretty good rundown on, net migration appreciation and uh, you know, how the market's performing. And then also, I think it's very important in a mature market to not go outside of your comfort zone too far above median home values. Zillow, again, free index on median home value. And, if you're investing 2 to 3x the median home value, you need to make sure that there's absorption for that sort of a product. There's enough buyers that can afford it. Um, and I think that's generally very important. It's also when you get into that like very dangerous zone of like 1.5 times the median home value, it's always a financed transaction for the end buyer. And the people who can qualify for those loans today on the conventional side can also qualify for a larger home and a nicer home. So they may not want yours. So let's just take an example. Let's just say a small. Let's just take Orlando, where we're both from, right? So median home value is what, 450,000, something like that today. If you have a $750,000 house in your suburb of Orlando, like Winter Garden, for example, it's 1.5 times the median home value. It's less affordable, less desirable home than if you had something that was 399,000 below the median home value. There's a lot of buyers in the market that can afford to buy that house versus yours, which would have a much smaller pool of buyers. Same scenario, you have a $1.5 million home in a better part of town where everyone's paying cash or can easily afford that, then maybe that's going to sell faster than your slightly above the median home price.
Absolutely. And you have to do some research on the regions you want to. Number one, where are the renters going? Like if you'd mentioned one of the areas here, whether it was Windermere or Winter Garden, I forgot which one you mentioned, but I wouldn't think there'd be a high rental desire for Windermere or Winter Garden, maybe Winter Garden, but not, I don't, maybe not Windermere or Heathrow, possibly to rent because the cost of the properties are so high to be. Who would want to spend? You'd be spending $5,000 a month to rent a place. Sure, there are people renting there, but it doesn't seem like that'd be a high market to want to try and rent a property.
Yeah, people are buying rentals in more expensive locations, mostly for the appreciation play. Not necessarily. Maybe it's for keeping money in the United States if they're foreign. And something that might be safe and stable, but not necessarily going to make much money or break even on cash flow. Um, I think that that's another point to make on like what to do in a mature market. If if where you can invest, if it's local to you or not, is a market where you can have a dual exit strategy for a short-term loan, that's super helpful. So if you renovate a property and you're planning on selling it and it hasn't sold yet, if it's not too expensive and it can cash flow as a rental, then you still have that option to take one of those rental loans from a company like ours and get out of the short-term loan that you have.
Right, that's a really good point. Yeah, your exit strategy has got to be just as important as can you afford the property plus any repairs. What have you seen the damage from a lot of fallout sometimes from Airbnb, where people, let's say, would then have the opposite idea of trying to go into Windermere. I'm just using a local example here, but a nicer, desirable area, maybe on a lake or somewhere that's near Disney, in order to rent it out. So they might want to do a rental property there. But what have you found that Airbnb has done? And has there been a lot of kickback with your organization with the lending side of things, or if we find out it's going to be Airbnb, they won't do it, or what have you found on your end?
So we're pretty conservative on that end. Like we don't finance a lot of short-term vacation rental. It's not been like a niche that we've really been too focused on, and that's been a good thing. And I haven't really throughout my career focused there because while it's great when it's working, you have two things that happen pretty frequently that impact those very quickly, right? One is new legislation. So a local municipality may outlaw short-term vacation rentals or restrict the
Happening
duration,
everywhere
right?
right now. It's happening all over the place. Yeah.
Right. So that's number one, like risk for you. If you're doing those, all of a sudden, the local hotel owners are sort of lobbying for not having as many of these in their community, or neighbors don't want them because they don't want to have a bunch of different people over at their house next door to
They call it
them.
NIMBY
And
out of my
yeah, strike
backyard.
exchange.
Yeah, NIMBY. Yeah, I got you.
Yeah, so then the other, big risk is then it's working really well. You have markets like Scottsdale, Arizona, where, if there are non-HOA areas in Phoenix, Arizona, the non-HOA neighborhoods, which, there aren't a ton of them in Scottsdale, but let's say that, for example, I think I saw during the Super Bowl when it was out there that there was like 50% occupancy on vacation rentals. And the reason that happened is like 50 something percent. But the reason that happened is that there were so many investors that saw the yields that other people were making, and they said, okay, I'm going to go do this too. And there's just kind of like oversupply for the demand. Um, and people had, more money maybe back then, expendable to them than what they have now today with like inflation on costs, and wages not keeping up with inflation. So, you know, there may be just less vacation travel to depend on as an Airbnb host. So just something to be extra cautious with legislation, or like if a lot of other people are doing it, if you're late to the game, that could impact you.
You got to be careful. You got to be ready to. You don't want to say be ready to lose, but you want to be ready to be prepared to say, look, something might happen. Oversaturation. If we're doing short,
Can I switch it to a long-term rental and still make enough money that it makes sense? That's a good rule of thumb.
and if you get a really good renter, you could have somebody in there for 5 or 10 years, maybe, or at least 4 or 5 years. And the longer you have somebody, the more stable the rent is, the more you make your money off of that, and then it's easier to find a new renter. Whereas if you have a short-term renter, there's a higher chance of them not trashing the place, but doing damage to the place as well. People could do damage to the property, or they could do, maybe come in and ruin things because they're short-term renters. Not to say it's different, but sometimes it's not the same situation. They're going to be in there for a shorter term. They're out. You got to be careful to make sure you keep your property value where it needs to be, and out of any damage situation. So it could be a lot of factors I think need to go into thinking before you go into the rental market. Whether you hire a tax person, working obviously with someone from your side, private money lending, also the historical situation with the area.
Well, there's another really key person to have on your team is the right insurance agent. And when you're looking at transactions, everything's looking great. Like I just bailed on one myself personally. And a broker called me. She sold a couple properties to me, and she said, "Hey, I have this deal where it's falling out of contract. Do you want to buy it if it falls out of contract?" I said, "Yeah, let's look at the numbers." And we settled on a price, very cheap, $103,000 for a block house in Florida, Crystal River. I know Crystal River is like 96% of the homes are in a flood zone. So what's the flood zone quote right now? Quickly got a quote for flood zone. It was like $5,500 a year just for the flood policy.
Oh my gosh! And then you have the home insurance and the potential for damage. There's a good deal, and then sometimes there's a deal that's a bit risky of a good deal.
Yeah. So the flood policy for me, made that a pass because, it just ate up too much of the cash flow of the rental.
Right. You got to look at the whole thing. I think that's why it's important to have, and you mentioned earlier, have a seasoned investor with you, maybe if possible, to partner with them, even if you have the funds. Maybe you don't have the expertise and if you're going to do something that's a bit riskier, find an area that is, kind of a proven track record for rental properties, not something hot and new, but something that's kind of well established over the years that, people in this area most likely are going to be renting, whether it's downtown.
When you're getting started, it's okay to hit a base hit or a
Yeah,
double.
that's right. That's a good way
No
to
big
put it. I
deal.
like that. Baseball terms. Yes. Hit a base hit.
Yeah.
As far as any kind of new trends or things, is there anything kind of trendy or new, or do you say sexy in the area of, like, of real estate investing, or with
Well, I would just say like smaller footprint homes are in demand and there's good absorption for them. I think that people have shied away from that historically, but where we're at now as a country is like affordability is really important. So like smaller footprint homes for a lot of investors are making good sense. And especially on the ground up side. So, builders that were building 15 and 1600, 1700 square foot homes are now building 11 to 1300 square foot homes. While that doesn't sound attractive, it is penciling better for them.
Well, I think there's a lot of kids coming out of college. They're like, I'm just resigning myself that I'll never live in a home. I'll rent forever. I can never afford it because, back when our parents or, grandparents, whatever, were looking for homes, and it was affordable. People can get in there. You get a job, and you and your wife are working, or whoever your spouse, whoever it may be. There's a really good chance you can get into a house. But nowadays, it's like, oh, geez, the kids come out of school thinking that may be an unattainable situation for me. So, like you said, a smaller footprint house. I've even seen these people on TV. They're called small homes, whatever. You know what I'm talking? Tiny homes, something I've heard they call it. Almost like a trailer that you transport and converted, and they do some good jobs. They make awnings and they can make them look nice with glass, but people are being more creative on buying property now because these homes are just not affordable at 450, 500,000 when you got student loans coming out of school. So renting may be a new thing that's maybe something for the younger generation or smaller homes. Uh, that's great. Any other trends you're seeing at all in the space you're working in or real estate?
There's a lot of different, ways people are getting creative. I don't think I'll mention too much because, I think that they largely, when you get creative, it largely impacts the optionality for financing. There's some really cool companies that are like adding bedrooms and bathrooms and en suites to properties and then renting out multiple tenants to the same property, but it takes out all of your options for financing. And I think it's being able to exit a short-term loan and being able to have like optionality in the capital, um, I think are, you know, more important than, maybe some current trends in that space. A lot of people doing, some things with like assisted living in their single family homes as opposed to standard tenants, seasonal rentals, corporate rentals. Um, there's people doing timeshares on single family properties or more luxury properties. And, there's a lot of interest in our space in tokenization of single family properties and shared ownership and shared vacation rentals. But I'm just seeing that it's largely not financeable because there's so much other like, normal loans that, the credit providers in our space can offer, the lenders can offer. So I think that, you know, being too creative can be a hindrance
You're
sometimes.
out risking yourself in a way. You're really out risking yourself if you go too creative. You want to keep it within the bounds. Um, I know a lot of things with the latest tax laws, the OBBBA. I feel like I always saying too many B's in there, but I just threw a couple extra just to make sure I get them all in. But with the new regs, I think that a good chunk of the regulations are staying in place for rental real estate, where the depreciation rules and
Bonus depreciation.
depreciation's coming back. Section 179. A lot of people do business. They should say valuations, or valuing, doing a kind of a revaluation of the property to try and get as.
Yeah, and a cost segregation study. Another thing you want to make sure you get done professionally because you don't want to get in any trouble
And
with
that's
the.
something that a lot of CPAs don't offer. We then become the person who say, hey, look, go to the CPA and they'll give you an advice on who to go to. And then they implement what they find. Because those will make a cost segregation will make such a difference getting your property into 15-year or 7-year that you wouldn't even realize it till 27 and a half years later. It is really beneficial, and whatever cost it is up front, it more than pays for itself. That's something they kept the rules on for cost seg. But one thing they're kind of getting rid of is a lot of the environmental credits like the solar. So I don't think that it would affect your industry much as far as, I'm not going to buy a house because solar credit's not available. But otherwise, luckily, I don't think a lot of the new regs are going to prohibit people from wanting to stay in rental real estate, and it might even encourage them to stay longer because the new or keeping on with with the bonus depreciation section 179. So I think that's a good thing. This is great. This has been great. I think maybe we can kind of talk a little bit about you now, unless you wanted to go more in more conversation. I think we kind of maybe transition now and talk more about Dustin Lauer, the person, and you, and maybe kind of bring me all the way back. I know we're going way back now to your childhood and kind of where you came from. Talk about everything. Give me updated on you as a person. Like, where did you grow up, and tell me about your school and your parents and everything.
Okay, sure. I mean, I've always been interested in like real estate, so I've been in the same industry since 2009. Right out of college, like even in my senior year. But grew up in South Bend, Indiana. So I'm a big Notre Dame fan, and we're 0-2 right now at the recording of this podcast. So we've got work to do. But I went to UCF in Central Florida, so obviously go Knights. And I think, I was in school during the financial crash of 2008, and I was really wanting to buy like a property to live in as opposed to pay so much for rent. That got me really interested there. I've been interested in economics my whole life. I was like, one of the only like football players, wrestlers that like was on the economics team. I think I was the only one in high school. So I was like super into econ, and I did economics challenge, and like, where you take economics tests against other schools, and just we're super interested in econ.
Did your parents? What did your parents do?
My dad was a professional bass fisherman. He also owned a landscape company. So he fished on a FLW tour, traveled with for that. My mom was a nurse. So
Oh my goodness, I didn't know that your dad was a professional. Wow, how cool is that? That's really fascinating.
yeah, so, like most childhood vacations were going to where he had a tournament or something, and, cheering him on and all that. And, I took to that as well. I, fished in college competitively, and, I fish tournaments now and then.
It's gonna sound dumb as I'm a non as a non-fisher, and I'll say, but what is there a secret to know where the fish are? Is there something you have to learn? Like, okay, this is the current flow, or is it just instincts, or how does that work to know where to get the fish from?
Well, I'd say like ever since like 2020 or so, it's really changed a lot. Like the technology's gotten so much better with forward facing sonar. So usually historically, like sonar went in one direction down. And then, years later, it started to go side to side. Now it can also go forward and around. So we had really good technology on that. It makes the boats really expensive these
Was it
days. But
Lowrance? What was the big one back in the '90s or back in the day? Was it Lowrance?
yeah, so Labras is still a major, provider of sonar in on the freshwater world.
Maybe I'm thinking of a different kind of radar, but it had the big long thing that went around like this. Then there's the one that went in the water, and like you said, you can almost see it started off as basic as a depth finder years ago, just to see how deep the water was. Then it, like you said, it downward facing and then forward facing. I didn't even know they did that kind of.
Yeah, it's kind of like a video game now where you can see the fish on the screen and throw the lure to them, and you can see the lure on the screen. So
That's almost half
really,
cheating, isn't it?
yeah, no, it's outlawed in some tournaments, and sometimes it's like sometimes they turn it off and on for certain tournaments. So just to keep it like more traditional, but it's a fun sport where it's not the same as like going out for the weekend fishing. It's like very competitive, and all the colors matter, and the baits matter, and the techniques matter, and
Wow.
it's fun targeting. It's more like hunting than anything.
Yeah, if you can do it without the radar, I mean, that would really make you hone into your own abilities, your natural abilities and instincts, or whatever it is, the flow of the water. I don't even know what things.
Yeah, there's so much to it. This water temperature, clarity, color, where the bait's at, uh, you know, uh, time of year, what the mating season is, if they're spawning or whole spawn. There's a lot to
I
it.
had no idea because I'm just thinking I throw a lure in the water, hope you don't hook the back of your head when you're doing it, or hook someone else's head by accident, and hope for the best. Well,
But yeah, I could talk fishing all day, and then that's a big passion of mine. And just kind of really like I guess maybe to afford fishing. Been real interested in this space, and I've never gotten tired of it since like '09 doing it. Um, and I was doing it for maybe 6 years before we had all the larger institutional capital come into the space. So I was going back and forth to retirement communities, and trying to show people what I do for their self-directed IRAs, and working with advisors and eventually broker dealers, and raising a few private funds over the years. Um, to raise capital to do this type of loans, as out of necessity. But these days, there's a lot of capital in space, so that's what I'm doing.
Yeah, I've known you for a while. I mean, obviously, I didn't know you back before you moved here. Obviously, I met you when you were here in Central Florida. When did you say?
Probably more 2015 or something like that.
You say, yeah, you've
2014.
been here 10 years. I don't know if I've known you 10 years, but it's got to be pretty
Close to it. Yeah.
close to that number. And I know the space was different back then. You've been through maybe a couple of different places before you had your own, and before you're at now. But the spaces you've been through, and I think the connotation for your industry has changed too, in more of a favorable light. Before it was kind of like, you get hard money lending. That was the word we don't use anymore. It sounds like, but it just didn't have a great connotation. Where I think nowadays the private money and actually the numbers are a lot closer to what they used to be. So it seems like your industry is going to become in a, I don't know, maybe I'm just overanalyzing, but it seems like it's kind of cyclical way now.
Yeah, definitely. It's been helpful to have so much capital to support the space. And there's a lot of aged housing stock in the United States, so it's not going anywhere. There's people think of like fix and flip as like only for like rising tides scenarios where things are appreciating. But in order for people to have an affordable home, they have to buy something that's move-in ready. Um, and a lot of the houses across the U.S., yes, there's more demand for new housing stock than most markets have for new homes, but I think largely there's an affordability concern there. But on the regular housing stock that exists already, um, a lot of it is 30, 50 years old, and maybe it's been updated once, but it could use it refreshed before somebody moves into
Yes,
it.
and they come in there, they change it and move forward with it. So it sounds like economics and numbers have been a passion years throughout your life, and obviously fishing, and then you've had some experience in the Midwest, which I think is a beautiful area. My son's going to school up in the Michigan area, which is but more southern in Grand Rapids. I think that's a little bit closer to South Bend than other parts of Michigan because it's more south. I don't think it's more than 4 hours from Grant. Well, maybe either way, but that area there, the people I think are great. The weather, a little bit
Yeah,
cold.
not so much.
Say too much, anybody's listening, but you can ski at least up there. Where a lot of places
Yeah,
it's cold, you can't ski.
I actually went skiing with friends of ours in Boyne, Michigan, a little north of there.
Oh, okay. Yeah, that's
Just this year.
if you're gonna have a place that's cold, I always say may get snow. If you're gonna be in a place that's cold and rainy and there's no snow, it's like, well, you're not getting the benefit of at least getting some kind of fun activity, sledding, skiing, or skiing, whatever it is. But yeah, but being in Florida, you can't you don't have to shovel heat. So even if it's hot in the summer, you can stay inside. Is what I say. Uh, but it's a great area. Obviously, you built yourself up in a nice place. And as a matter of fact, maybe tell me more about your business side of things. Maybe promote what it is you want to promote about your business. Just let everybody know all about you, how to get a hold of you. Tell us more about your business that you work for. Kind of give us the name. Just go ahead and do a little bit more on the business.
Yeah, sure. So Lenmark started around the same time I started my own business. Um, so it's been on open 8 years, and it's kind of built up a really impressive capital stack. So it's backed by a hedge fund as well as a family office today. And really it's grown a lot. And I finally partnered up with the guys there, a little while ago. Um, and really like what our kind of advantages are in the space, like everyone has capital today in the space, but I think our advantages is like kind of a much more professional team that understands the business very well. We've all done transactions directly, and we kind of come from either finance backgrounds or direct private lending, and I have like 16 years of experience doing this, and a lot of the rest of the team has as close to that in experience. It's not like that big of a long term of an industry, so you get to work with kind of like best in class you know folks, and a lot of what we're doing, right now we have like leading pricing on the rentals. So obviously that's a very price specific product. So we're getting a lot of rental loans. But I've always focused on the builders since I got started, because for me, like customer acquisition, we get a builder as a client. I don't do the sales anymore. I lead the team, but we get one customer and they come to you sometimes for 10 transactions or sometimes for 800. And it's just, very repeated, very much a relationship based. And I take a lot of pride in like having the same customers from when I very first started in the
Wow,
space.
that's
So
great. That's
yeah, same people I'm still, talking to on the phone. We text, we figure out transactions together and I get them with the right, person on my team to get their loans closed. But
I'm curious when it comes to see underwriting in house, or do they have to deal with a third party person that's somewhere out of state? Like, is that all the underwriting process within your organization, like real time? How does that?
yeah, so the staff is getting pretty close to 90. Um, so we're all in house across the board. So even like on the servicing side, we have a servicing company, we have a processing, like we even brand it separately because we do this for some other lenders. Um, so we've got processing, underwriting, servicing, construction management, where we're releasing the draws. All of that's in house. So all the sales is in house.
So everything's there. So it's easy, kind of a one stop shop for people to kind of come in and get a chance to number one meet you. Like you said, you deal with more people person to person as opposed to that deli example where you just take a number and move on. You build a relationship with people, which is great. Uh,
Yeah, I think that's the key thing. That's what gets me up to go to work, every day. Just more so, like those longer standing people. People rely on you. You build those relationships, and it's that's I think like there's a lot of like on the economic side. There's a lot of impact. So it's not like we're out loan sharking, charging high rates and fees. Like, when I do a loan for somebody, a title agent gets business, a real estate broker gets business once or twice. Sometimes there's a mortgage broker involved because we're direct capital and not a lot of people find direct capital. So there's usually a mortgage broker. There could be, an insurance agent that's getting paid, an accountant, lawyers. There's a lot of like economic impact before even closing. And then at that time, you've got, painters, drywall guys, roofers, electricians, HVAC, everybody under the sun, concrete companies, everyone's benefiting from, this capital infusion to the market. Uh, and at the end of the day, the homeowner is getting, a nicer house at the end of the day.
Oh, 100%. Everybody benefits from that. And then if it's a rental property, you get the tenants who are going to have a better house than they would maybe if they're renting through an apartment complex, a better property. So it does. It affects the community. What you
Yeah. I couldn't do something for like long term, like career wise, if it wasn't like something that I like believed in. I think that's the
100%. You and me both. And that's why I try and do one person, a customer, client, however we refer to them at a time. It's not take a number. I know my clients and people well. They know me. I've had some, relationships for years, and that's kind of how I do things. I don't like to have a stand open and it's only open for 6 months of the year and then close just like you. You want to keep that relationship going for long term. That's do you want to tell people how they can get a hold of you or your organization, like real specific? Like,
I would say like through the website, it's probably best. Lenmark.com. It's Mark with a Q, MARQ. And if you reach out there to us, we'll get in touch with you. I'm certainly available, but I'll make sure that we have somebody in your time zone that has the expertise required to handle your scenario. I've hired a lot of the staff at this point, working here. So it's pretty much all people that you would want to be handling maybe a larger financial transaction of yours. So
okay, great. So people are going to get a hold of your team and you through the website, and then you'll make sure if they hear of you from the guest of this show or listening to this podcast, I should say, then you can direct them to whoever team member is best suited, whether it's you or somebody else. Then
yeah, absolutely, that'd be great.
great. That's all. And Dustin, thank you so much. I know my listeners are really going to love listening to this, and I really appreciate it. And thank you for being on the show.
Yeah, just all these different random businesses that are out there. So thanks for letting me talk about mine. Thanks, Greg.
Absolutely. Absolutely. That brings us to the end of another episode. and we'll see everybody on the next episode.
Behind Closed Books podcast requires more than a conversation. It takes action, research, and collective wisdom. If today's episode resonated with you, we'd love to hear your insights. Join the conversation and help us shape the future together. We'll be back with more stories, strategies, and real-world solutions that are making a difference for everyone. In the meantime, be sure to subscribe, rate, write a review, and share it with someone you think would benefit from it too. Thanks for listening, and we'll see you on the next episode.